Most traders think risk to reward is just a number. They think it is a simple ratio, 1 to 2, 1 to 3. Risk $1 to make $2. Risk $1 to make $3. And they believe that once they understand this ratio, they understand risk. But that is not the truth. Because risk to reward is not just a number. It is a mindset. It is a way of thinking. It is a way of behaving. And without the right psychology, even a perfect risk-to-reward ratio will not help you. In this video, I want to explain something very important: the psychology of risk-to-reward in trading. Because once you understand this deeply, your decisions will change, your patience will improve, your discipline will become stronger, and your results will become more consistent. If you stay with me until the end of this video, you will understand why most traders fail to follow risk to reward, how professionals actually think about it, and how you can build a mindset that allows you to execute it with confidence. And if you want to continue building a strong trading mindset, consider subscribing to Bull Mindset. This channel is focused on trading psychology, discipline, and long-term consistency. Now let us begin with a simple truth. Risk to reward only works if you follow it. That sounds obvious, but this is where most traders fail. They calculate their risk, they calculate their reward. They plan a 1 to 3 trade. But when the trade is live, everything changes. The market moves slightly in their favor. They feel excited. They close the trade early. They take a small profit. Or the market moves slightly against them. They feel fear. They move their stop loss. They increase their risk. So even though they understand the ratio, they do not follow it. This is not a technical problem. This is a psychological problem. Now let us go deeper. What does risk to reward really represent? It represents your willingness to accept small losses for larger gains. That is the core idea. You accept that you will lose, but when you win bigger. This creates an edge over time. But the human mind does not naturally like this, because the human mind wants certainty. It wants frequent rewards. It wants to feel right. So when you take a small loss, it feels painful. And when you have a small profit, it feels good. So traders do something very common. They cut their winners early, and they let their losses grow. This completely destroys the risk-to-reward structure. Now let us talk about why this happens. The first reason is fear of losing profit. When a trade goes into profit, even a small amount, the brain wants to protect it. It says, close the trade now. Take the money. Do not risk losing it. This is why many traders close trades too early. They are not thinking about the planned reward. They are reacting to emotion. The second reason is fear of being wrong. When a trade goes into loss, traders do not want to accept it. They do not want to be wrong. So they move the stop loss. They give the trade more room. They hope the market will come back. But this increases the loss. This is the opposite of what risk to reward requires. Now let us talk about how professionals think differently. They do not focus on individual trades. They focus on the series of trades. They understand that some trades will lose. They accept it. They do not try to avoid losses. They control them. And they allow winning trades to reach their full potential. This is the key difference. Now let us go deeper into the concept of patience. Risk to reward requires patience. Because large rewards take time. The market does not move instantly to your target. There will be pullbacks. There will be fluctuations. And during this time, emotions appear. Doubt appears. Fear appears. This is where most traders exit early. But professionals stay patient. They trust their plan. They allow the trade to develop. Now let us move into real trading examples. Imagine a trader who enters a trade with a 1 to 3 risk to reward ratio. The trade goes into small profit. They feel good. They close the trade. They take a small gain. Later, the market continues to their original target. This creates frustration. But this happens repeatedly. Now imagine a professional trader. They enter the same trade. The trade goes into small profit. They do nothing. They follow their plan. They allow the trade to reach the target or stop loss. Over time, this creates larger gains. Now let us consider another situation. A trader enters a trade. The trade goes into loss. They feel uncomfortable. They move their stop loss. They increase the risk. Now the loss becomes larger. Now imagine a disciplined trader. They enter the same trade. The trade reaches the stop loss. They accept it. They move on. The loss is small. Their capital is protected. Now let us talk about another important idea. Risk to reward is connected to probability. You do not need to win every trade. You need to manage your wins and losses correctly. For example, if you have a 1-to-3 risk-to-reward ratio, you can lose more trades than you win and still be profitable, but only if you follow the plan. Now let us talk about mental frameworks that support this mindset. The first framework is delayed gratification. You must be willing to wait for larger rewards, not take small profits quickly. The second framework is acceptance of loss. You must accept small losses as part of the system. The third framework is trust in your plan. You must trust your risk-to-reward structure. The fourth framework is emotional control. Do not let fear or excitement change your decisions. Now let us talk about practical exercises. One powerful exercise is predefining your trade. Before entering, decide your risk and reward, and commit to it. Another exercise is not watching every tick. Constantly watching the chart increases emotional pressure. Another helpful practice is journaling. After each trade, write down, did I follow my risk-to-reward plan? This builds awareness. Another exercise is reviewing your exits. Look at trades where you exited early. Understand why. This helps you improve. If this video is helping you understand risk-to-reward in a deeper way, consider subscribing to Bull Mindset, because understanding the psychology behind it is what creates real consistency. Now let us talk about something deeper. Risk-to-reward is not just a tool. It is a discipline system. It forces you to think long-term. It forces you to accept losses. It forces you to stay patient. And these qualities are what make a successful trader. Now let us move toward the final message. You will feel the urge to close trades early. You will feel the urge to avoid losses. You will feel the urge to change your plan. This is normal, but your behavior does not need to follow those emotions, because your success is not based on one trade. It is based on consistent execution over many trades. Let me leave you with one final thought. Risk to reward is not about numbers. It is about discipline. It is about patience. It is about trust. Master these, and your results will follow. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video.